Hello viewers, today we are resuming with our series on group accounting, and according to where we stopped, the part 3 of the video we uploaded yesterday, we tried to look at the IFRS 10, that is consolidated financial statements, and we saw from there that it is a requirement or the standard permits us to prepare the consolidated financial statements when you have a parent and a subsidiary relationship. So as a precursor of what we did in the previous videos, remember we said that if one company buys more than 50% shares in another company, we end up having a parent to subsidiary relationship. And that parent to subsidiary relationship forms what we call a group. So as we are going into our group accounting, it means from that stage we have already formed our group, meaning we have both the parent and the subsidiary company. So this means that parent to subsidiary relationship means that the parent at the end of the year must prepare the consolidated financial statements, which are going to be combining the financial statements of the parent and those of the subsidiary company. So at the end of the day, we need to present the group financial statements. And the only way we can do that by combining the financials for the parent and the financials for the subsidiary, because the two have become a single unit. So therefore, that brought us to the stages or the steps that we go through when we are preparing these financial statements, the one we call steps in group accounting. So these steps, we are going to look at them one by one, and we try to understand these stages, because these are the things that you are going to find in the question. First of all, when you are given any group accounting question, the first thing you look at is determining the group structure. So when you determine the group structure, that is going to be the first stage. But before we say we look at that, because our main focus here is preparation of those group financial statements. We say those are going to be the income statement, the balance sheet, maybe the changes in equity. But for the cash flow, we say that one we shall do it when you go to advanced financial reporting. So in terms of knowing what should be done to prepare these consolidated financial statements, we have to look at some workings, or we have to do some workings. Since every company is preparing its financials separately, we need to look at some of the steps that we need to go through so that we can be able to prepare these consolidated, or we can combine those accounts for the two companies in order to form what we call a group. So, as I said, the first step is looking at the group structure. And this mainly the relationship between the two or more companies, because we said you may find that it is one company buying shares, buying more than 50% in different companies. It may be buying from company A, company B, company C. So if it is only one company and the company has bought more than 50% of the shares of that company, then we say we are going to be having a parent to subsidiary relationship. We talked about what a parent company is. We spoke about what a subsidiary company is. And the relationship that exists between those two is what we call the group. And it is the financials for the group that we need to prepare at the end of the year. So that's basically the relationship between the two companies in a business combination. When they come together, then we need to know the group structure. So by helping us to know the group structure, or in terms of which one is the parent and which one is the subsidiary company, we mainly focus on the percentages. In the question, you'll be given these percentages that maybe the company bought 50%, or it bought maybe 60 or 70 or 80% of the company, of the shares of another company. So what we look at here is that the percentage should be exceeding 50%. Meaning, if the company has bought maybe 80%, we say that it has obtained control over that company. So it becomes the parent company. Then we have also the portion that is not controlled by that company, because we say that it has bought 80% of the shares of the company. Meaning the remaining 20% is now the non-controlling interest, or the one that is owned by these subsidiary or these other shareholders who are taking only 20%. That's what we call the non-controlling interest. So the controlling interest is, as you've seen, we have an example here. We can see that we have Pichu Limited, which is the parent company. It has obtained 80% of shares from XY Limited, meaning since Pichu Limited obtained 80%, we are saying that this 80% is going to be representing the parent company, and the 20% is going to be the subsidiary, which we call the non-controlling interest. So the next item we look at in the determination of the group structure, we look at also the acquisition date. When is this company buying off the other one? Or when, of course, when you try to look at the acquisition date, you may find that by the time the company is acquiring shares in another company, it will not be maybe at the end of the year. It may be during the period of the year, of a given financial year. So since it is going to be acquiring this company, and the reason why we try to look at that acquisition date is because we want to determine some of the post-acquisition earnings that will be earned. Because if at all the company has acquired maybe another 80% in another company, we are trying to look at from that date up to the date, up to the reporting, actually that acquisition date when they have acquired the shares, it is what we call the acquisition date. Then from that period up to when the financial year is ending, or the reporting period, you may find that there are some amounts that this company which is buying shares in let's say in the middle of the year is going to be having some earnings, not for the whole full year, but for that part where it became part of that company. So normally our first working is always to first determine the parent company and the subsidiary company. Then we also look at which one is going to be controlling which one, meaning the parent company is now going to be the controlling interest, and we also determine the non-controlling interest, which is going to be belonging to the subsidiary company. And the last thing we look at is the acquisition date. It is very important because when we move ahead, as we start preparing the financials for the income statement, if at all the company has not been there, or it has not acquired that company at the beginning of the year, it means we have to time apportion the sales that were made, actually the profit that we have acquired, so that we know what was that profit that the company acquired at the point when they joined the company. Because for the income statement, you know, it is always prepared for the year end, meaning it is for the whole financial year. But now what will happen if at all the company was acquired in the middle of the year? It means the first 6 months are not going to be part of that company. The profit that was made in those months will not be part of the parent company, but it will only take a share of the 6 months where it has been part of that group. So that's basically why we determine that acquisition date, and it is very important. So that's basically what we look at as our first step. Then we have the second step that we'll go to after determining the group structure, and that is preparation of the net asset schedule of the subsidiary at acquisition date and the reporting date. Meaning here we are going to be looking at two scenarios. We look at the acquisition date and the reporting date. So that's what we are going to be looking at in the part 2 of this video, because I don't want to take it very hard for you guys, because this is something that we need to understand, because there is no way you are going to pass any number on group accounting if at all you have not mastered these steps, because sometimes they will not ask for those combined financial statements. Sometimes they may ask you for these workings. They tell you calculate the goodwill, you calculate the post-acquisition earnings, and those are the things we are going to be going through in this step-by-step model that we take into the group accounting. So it's what we are going to be handling, and basically it will be in our next video, because I don't want to make this video too long, so that you take small time, you can be able to rewatch and rewatch, so that you master each and everything until we finish all these steps that are taken within the group accounting. So if you haven't subscribed, make sure you subscribe, you hit the notification button, so that you can be able to get updates on whichever videos we are going to be uploading. So that's the end of our part 1 of the steps in a group accounting, until we meet in the part 2 of these same steps in group accounting.